Apparently, I'm a fucking moron. That's because millions of people in the market are expecting higher for longer inflation, higher oil prices, and a continuing Iran conflict. They think we're going to have 2 rate hikes this year, and that's bad for stocks. But I'm going to go out on a limb here and tell you that that's wrong, but now for the reasons that you expect, and you should care because it affects your bills and which stocks will make money and which will crash and burn. In this video, I'm going to walk you through 3 considerations: the economic environment, the Iran war, and the incentives of Kevin Warsh, who's in charge of the Fed. Then at the end, what sectors is this bullish for? Ultimately, nothing is for certain and everything is a probability. In an alternate timeline, it's already Armageddon. Let's be honest, the economy sucks for most of us, housing is unaffordable, and groceries and gas bills are high. But whether you like it or not, the top 10% make up 50% of consumption, and higher gas prices are not going to cripple them unless it's meaningfully higher. They're sensitive to wealth, not income, and the stock market's doing fine. Macro data is coming in strong. Unemployment is low, goods shipment data is improving. The only thing that could throw this off is a really bad escalation of the Iran war. Now, the Iran war has admittedly thrown me for a spin. At this point, we all know that Iran has advantages in its terrain, control over choke points like the Strait of Hormuz and the Bab el-Mandeb, cheap drones, and a more radical regime than before. In March, I thought the chances of a long, drawn-out war were incredibly high because the US would never concede, pay reparations, and lose control over sea lanes, and that meant a ground invasion was inevitable. But Trump surprised me, and he signed an MOU giving Iran pretty much everything they wanted. Say what you will, but it was genuinely the best move he could have made at that point in time. The alternative was a disaster, and he literally admitted it on camera. I would have also expected Iran to push for more, but they seemed happy to move towards stability, and that tells me they too were feeling some kind of pressure, perhaps from China, who will soon run out of reserves. Both parties have shown their hands, and despite all of the increasing escalation, it's more likely that we get a sudden 180, oil comes down, and then there's no need for rate hikes. If this kept going instead, the outcome would have been so bad that Trump for sure would have lost the House, and that means Democrats can launch aggressive investigations into him and block new laws, and he does not want that. Now let's look at the Fed chair. He was put in by Trump basically to cut rates, but he leans towards raising rates, and he said a number of times that he has no tolerance for high inflation. On one hand, he has no reason to fear Trump. Trump just tried to fire a Fed governor, and his Supreme Court stopped it, so Kevin knows that he can't get fired, and Kevin's wife is a billionaire. If I'm a billionaire with fuck you money, I'm not going to be someone's bitch. I'm going to stand on business and prioritize my legacy. But what does matter is Kevin's father-in-law is a big daughter and longtime friend of Trump. Raising rates would hurt Trump in the midterms, and I don't think he personally wants to do that. So what this means is no rate hikes until the midterms, but with spending and the economy heating up, I think its hawkish nature will shine bright in mid-2027, and we'll see rate hikes then. So what does this mean for you? If rates are going to hold, having the scare on industrial stocks and semiconductors is overcome, goods shipment data is improving, and businesses are selling more than they are investing in inventory, and it's the best it's been since November 2021. Remember that. The economy moves in cycles between goods versus services consumption, and we might be shifting back to goods, and that suggests bullishness for luxury consumer discretionary stocks in the US, and more broadly, the US consumer discretionary index, because the whole sector has been facing pressure and people are overly negative. There you have it. I'd love to hear what you think, where you disagree. Ultimately, this is all for educational purposes and isn't advice. Hit the subscribe button and comment where you'd like to see dissected next. See you next time.